I'm going to kick this off. Thank you for joining us, everybody. I'm delighted to have back from the Vouch team, Sebastian and Chris. I think it's been a good quarter since we've done one of these. That's a great cadence, so for founders, because what you really want to do is kind of check in on where you are in your startup path and be sure you're appropriately covered for hopefully the good stuff that happened the previous quarter. And so that's exactly where we're bringing it, Vouch in. They are experts among experts about insurance, and their company is uniquely created. There are many, many different kinds of insurance companies out there, brokers and underwriters for all different industries and whatnot, but they often take a sledgehammer approach to things where it's like big policy when you're at a given stage and just don't, sign the PDFs and don't bother with it. Vouch has nicely used technology to break down policies that meet you more where you're at, which is perfect for startups because startups generally start brand new and they don't need everything until they hit certain milestones. And what those milestones when to think about it is exactly why we're here. And Vouch kind of preaches the same gospel we do into the spaces. The ounce of prevention can be worth a pound of cure. You know, the overnight successes of the startup world are usually 7 to 10 years worth of endless pivoting and grinding and building and doing things right and learning the wrong lesson. But similar to Gust launch and mission control, the Vouch team is like, hey, we can help bridge that 80% gap for founders. We can make it so that they know just enough to avoid a couple of the landmines, knowing they're still going to step on some other ones, but hopefully the ones that are well known are the ones that we can help them prevent. So I'm going to pass it over to Sebastian. They're going to run us through a presentation about how to de-risk your startup from an insurance standpoint. And don't be too scared of it. It's a more boring topic, but it is actually very important. And there's very small steps you can take along the way to really, really protect it once you start creating value. Because the last thing you want to do is have a impossible startup success and then lose half of it to some silly incident that, was preventable or insurable. All right, Sebastian, take us away. And oh, as always, we're recording this. We'll distribute your recording afterwards. Please use the chat. I'm going to open everything's up. Tell us where you're coming from. We'll engage with you guys. I will answer things in the chat as I can if you have any questions that I can understand. Big caveat, I am not a broker and underwriter, so I can't give you insurance advice. And even Sebastian and Chris can't. They can just they can answer general purpose questions and point you in the right direction. But it is an area that you want some sensitivity around. But chat should be open. Take it away.
Thank you very much, Nash. Appreciate it. And great to be joined with the Gust audience again. We're super excited to always connect with you guys and really happy to be calling in from San Diego in my case. I've got my colleague Chris, who's our senior insurance advisor. He is calling in from Boulder, Colorado. And we're really happy to talk with you about the most exciting topic in our minds, business insurance 101. And so really we want to keep this, fresh and interactive, and give you guys an overview of the types of milestones that your company will go through, and what insurances you should possibly be thinking about at those times in your journey. So we'll kind of kick things off, but feel free to jump in with questions in the chat. We'll try to grab them as we can without, pausing too much. So thanks a lot. And I should mention we both are from Vouch. We partnered with Gust for many years now, and Vouch was as Nash mentioned is specifically created to help the startup community bridge the gap that has existed in the insurance world for a long time. A lot of traditional insurers look at you as software CD-ROM or some very, very broad-based tech companies. And we know there's a lot more nuance to the business models that all the tech companies have. And that's exactly what Vouch was created to do, to be able to serve that customer base early in their journey before they are fully understood by the traditional insurers. So feel happy to answer any Vouch related questions, but we keep this presentation a lot more general, just in respect to the types of coverages that you might be considering as you grow and scale. So kind of went through introductions already, but what else we have on the table is just thinking about how to manage risk, mitigate it, transfer it to an insurer, why insurance matters and when it might matter. We have a number of examples throughout the presentation just to bring these claim scenarios to life for you to apply to your own business. Insurance is quite different, or commercial insurance is quite different than personal insurance. For homeowners or auto, they look at the state you live in, the zip code, the size of the home, or the cost of the car to underwrite you. Commercial insurance, there's a lot more gray area involved, and so being a little bit knowledgeable about how insurance comes together and why it comes together will help you understand and analyze your quote while you're helping get assistance from a broker or insurance advisor like Chris. So we'll kick off and look at the ways that you can manage risk. You have four options to manage risk, and we think about it in a matrix that looks at frequency of an event happening, and the severity if the event does happen. So on the top left here, thinking about low frequency, low severity, you might just accept that, hey, if it happens, we'll pay some sort of penalty. We'll may have to pay out a customer or settle a claim. You may just accept that. You could also mitigate the risk by implementing better controls or internal policies to deal with something if it's high frequency but low severity. If you have high severity but low frequency, you might choose to transfer the risk, and that would be bringing in an insurance policy to help protect you from those one-off scenarios. Or you might avoid entire doing an activity or entering into an area that has too much risk for you to that you don't want to avoid. So looking at an example, if cyber attacks are your biggest risk, if you think it will be low frequency and low severity, you can just hope nothing bad happens. You might be able to mitigate it by implementing cybersecurity for a framework or controls in place. You might avoid it by not operating digitally, and I think we would all agree that that's probably not a path that you can do in today's day and age while growing your business. Or you could transfer it by buying cyber insurance and paying an insurer to take on the risk for you and protect you from the downside that might derail your entire company's path due to one rogue event. Of course, we'll focus on this one a lot throughout this presentation. So who buys business insurance at company formation? And from our research, we found that no first-time founders do. Business insurance is something that typically comes up when it's a need to have, not a want to have. And we actually see that shift for second-time founders. Second-time founders, 2/3 of the time, are buying insurance right at incorporation. They might only buy simple insurance, but they know that it unlocks gates that they might run into in the early stages of development. Think about the first time you sign an office lease. That might necessitate that you have general liability in place, which is very much a pretty simple and quick experience to buy. Also is pretty cheap to buy. So a lot of founders will buy that pretty early on in their second time founding a company. And we'll talk about some of the other milestones that you might encounter that you should be thinking about and understand what types of insurance might be relevant at that time as a founder and the captain of the ship. So insurance is typically required to grow. If you've ever signed any enterprise sales contract, you know that they'll often ask for some insurance to be able to enter into an agreement with an enterprise level sales contract. And that's typically to make sure that any PII that and data that they're exchanging with you is protected, to make sure that you have protection from getting sued from your other clients. And so generally they want to make sure that any agreement they enter into is as low risk as possible. And that means that their partners and counterparts have to also be well insured. Starting from the bottom here, in formation, you might have, again, a lease or your first employee that might necessitate a look at insurance. During like that launching a product phase, getting your product in market, you might be collecting PII. You might have a financing event, either seed capital or safe. And all of those, might dictate that you get some level of insurance protection. And Chris is going to go into a lot more detail about exactly what those protections look like. But safe to say, as your company grows in complexity and scales its products in market, a number of employees, all of that business growth comes with bigger business risks, which again, those first-time founders don't have a great feel for exactly where those landmines are. The second-time founders that get insurance early on are looking ahead to where those landmines exist. Just a quick legal disclaimer. Insurance is rarely cut and dry. There's a lot of gray area. We can't speak for other insurers or how they do things. We'll try to be specific about what Vouch can do and be as specific to your business lines as possible. But there's definitely some gray area, and we'd suggest talking with us or another insurance carrier or broker to talk about that are specific to your business before you go ahead and purchase. And at this point, I want to kick it over to Chris to talk a little bit more about the specific insurance types and when they're coming up.
Awesome. Thanks so much, Sebastian. Glad to be here with everybody. So we'll be kind of going through a different few high-level milestones of when we typically recommend clients purchase this coverage. Now, again, that kind of might change depending on your timeline and certain contract requirements that you run into. But this is intended to really give you just a high-level overview of, hey, I'm at this stage. What are the coverages I should be thinking about? What would somebody from Vouch, like me, a senior insurance advisor, kind of typically recommend for my company at this stage? So starting off with incorporation there. So some key risk topics to consider, getting into an office lease, maybe. Maybe you're trying to rent your first office. Maybe you're buying some business equipment, whether that be laptops, furniture, furnishings, things like that. Or maybe you're just trying to sign your first client and they want to see a very basic general liability and policy in place. So that's what we're going to be kind of discussing through these next few slides here. So starting with the big one, this is going to be the most common requirement you run into, a really good kind of like first foundational policy for a lot of technology companies, but companies in general to consider here. Most basically, think of this general liability coverage as designed to protect your company against like trip and fall scenarios. So you have a third party coming into an office space. Maybe they were to trip and fall, hold you liable for that and those medical expenses. That's where this type of policy can come into, or in the event something like property damage were to occur. So few key kind of triggers for this. If you're a software company operating fully remotely, this is something you can generally kind of kick the can on and move down the line a little bit further here. Since you're maybe, hey, not working in an office space, maybe there's no hardware component to your products themselves. But if there is potential for third-party injury or property damage because of the products or services that you're providing, this is certainly one to consider as a first good initial step to mitigate and to provide liability expenses, defense costs, settlements, fines, judgments, etc., against anything that were to occur from like a property damage or third-party injury perspective. It
Chris,
can ease, yeah.
sorry, real quick. Do you want to define real quick first party versus third party? I think that
Oh,
can,
yeah.
I mean, a little insurance specific that the audience might be curious to learn, like how that changes coverage.
I think you're right, Sebastian. So when I say third party, think of somebody from outside your company. So that could be like a UPS delivery man, that could be a client of yours, somebody along those lines outside of your company. Now, when we say first party, think of that as being for your company itself. So even inclusive of founders, leadership team, executives, but also your own employees. So that'd be the main distinguishing factor between those two. First party, think of you. Third party, think of an outside, different kind of party there when we're using those terms. Thanks for doing that, Sebastian. And then wanted to kind of just call out the little table that we have in the right-hand corner of the slide here. This, don't think of this as like premiums associated with this type of policy. This is going to be more industry specific and then typical guidelines for the coverage limits we recommend based on certain like revenue figures as you hit those. So that's something to consider as well. Just starting out with 0 to 1 million revenue can typically secure a lower priced, lower coverage limit type of general liability policy there to get you at least started and operating appropriately there.
Is there actually, can
Yeah.
you jump back to that real quick? I noticed there's a trend there of like leveling off, as revenue grows. Is that because in the early days, you know, 0 to 1 million revenue, if you lose 10 to 20% of it, it's significantly your business's entire existence. While if you're at, I don't know, 20 million revenue, even if you lost, 10% of your revenue due to an incident, the insurance just doesn't scale at the same level.
Yeah, it's a great question, Ryan. And sometimes it does come down to that, as well as like statute of limitations when it comes to, hey, how much can somebody hold you liable for in this sort of instance? So especially when we see like a lot of our clients being software first, kind of earlier stage technology startups, there's really not too much risk there in general, which is why we'd say, hey, like a lower coverage limit would be fine. But to your point as well, there is some self-insurance that comes into play once you hit those higher revenue figures as well, where it's just be very difficult or maybe not cost effective to purchase something like a 25 million or $50 million policy to protect that revenue.
How many people are going to slip and fall at your company every
Right. That's
every
it.
week, even if you're making that revenue? Gotcha.
Yeah, like would you ever tap into this and use it? So that's kind of where we're coming from these general benchmarking. Exactly. And going back to that, these are going to be some typical like claim scenarios that the general liability is designed to protect against. So think of this again like that slip and fall. Think of general liability really as like slip and fall coverage. If somebody were to sue you, one of your clients, outside member, coming into the office for those legal fees and medical expenses if they're injured on premise or because of your product. That's where we get into the device malfunctions coverage as well. Let's say maybe you actually do have a hardware component to your product and services that you're providing. Maybe there's faulty installation and that were to cause some sort of fire or property damage were to occur there. That's where this policy can come into play as well. Go ahead and pick up those defense fees if a lawsuit were to follow, but then also compensate the affected parties for either that like property damage or any injuries that they may have incurred as well. Business property. So this is typically going to be bundled with general liability. Some carriers will offer the ability to kind of break the two out and purchase either one or the other. Business property, think of this most basically as protecting the stuff that your business owns. So again, that could be laptops, that could be desks, that could be chairs, that could be stock or inventory, depending on the space in which you operate. A few different factors that kind of go into that. And then what you want to think of from a coverage limit with the business property perspective is the value it would or what it would cost to replace those items that you're looking to protect. So if you're a remote, again, like SaaS company, maybe it's just two or three laptops. Think of the cost of what it would take to kind of replace those Apple laptops or whatever it may be new today. Now, if you are a company, maybe you work as an e-commerce, you're shipping stuff out a lot, you're actually holding inventory or making a physical product or designing physical prototypes. Think of the value of what it would cost to kind of replace those if there were to be an instance of theft, if there were to be an instance of fire, if there were to be just some sort of like general flood or other some sort of loss that were to impact the business property, damage it, make it unusable there. So typical cost, again, pretty low. This is what we're protecting against would be like those stolen goods and things like that as well. Um, and then, yeah, key trends that we're seeing again, just in a remote world where a lot of us are operating remotely, it's beneficial to look at what we would call the coverage territory for your policies. And what that means is where the coverage is designed to respond. So whether that be worldwide, so you might have people operating all across the globe, or whether it's more domestic, located just to designed to pick up damage to property that occurs within the US or Canada. So that's something to consider as well when considering a business property coverage or policy there. And then, yeah, these are common instances. So stolen goods, this is a big one. Like this kind of says here from a high level, maybe you're working at a co-working space, you go to grab some extra coffee or go to the restroom real quick. All of a sudden you come back to your desk, you notice that your laptop's no longer there. This is one of those coverages where it's like, oh no, I need that to operate. Designed to be covered under your business property coverage, can file that claim and hopefully get it pretty quickly replaced there for you. Another one that could be a little more one-off would be like something even as crazy as a lightning strike hitting a building during a severe thunderstorm that then kind of power surge damages your property or equipment. Something like that as well, designed to be picked up by the business property coverage. These mainly protecting against theft, accidental loss to property, so coffee spills, drops, and then those natural occurrences as well, like a lightning strike. Awesome. So those are really kind of main features for just getting off the ground, just incorporating your company there. Think general liability, business property, typically lower premium, good policies to kind of get you started at least and have your foot in the door when it comes to insurance and proactively kind of transferring those risks. Now we'll move on to the employees. So these are going to be coverages to start thinking of as you start growing your team outside of the executives and founders there. So as you start hiring full-time employees, maybe even contractors or like, oh gosh, I can't think of the word, people who volunteers there for your company as well. So these important coverages are going to be along the lines of workers' compensation, and then employment practices liability as well. And we'll dive into those key risk topics kind of related to each of these coverages here. So workers' compensation, if you remember going back to the general liability, we talked about how it's for third party. So people outside of your company, if they were to be injured, protecting against that. Workers' compensation going to be very much so first party. So think of this now as if you or one of your employees is hurt in the course of business. That could be as mundane and silly sounding as someone having complaints of like carpal tunnel syndrome if they're working off of a computer. Maybe they're at a trade show and they slip on a banana peel and hurt themselves and aren't able to work for a while. Maybe you're actually in the construction space and responsible for installations and somebody hits their hand with a hammer or something goes wrong with a drill. Those are instances where the workers' compensation is designed to come into play, pick up the expenses related to the injuries themselves, and then also some expenses while those employees are no longer able to kind of work, so that they can maintain their living standards, and still get compensated and paid, if there's going to be some sort of accident or disease or something like that that they run into. Now, this one is required in all 50 states after your first full-time employee. Some states are going to be quicker to fine if you don't have workers' compensation in place than others. So I know New York, for instance, will get on you pretty quickly, if you're hiring people and you don't happen to have this in place already. So to avoid those fines, it's best to look to secure this coverage pretty quickly as you're hiring those people through somebody like your payroll provider or your PEO, since they'll already have that information on place and then should be able to pretty quickly generate a quote, and then insure those employees as they come on, as they leave the company, etc. So, um,
Is that anything, is there like supplementary workers' comp that you guys dabble in, or do you just highlight this because it's just the part of the broad umbrella of insurance?
Yeah, so we are able to act as a digital broker and go secure this from some of our carrier partners. I always do typically tend to kind of move people towards the payroll provider or PEO, just from an administrative standpoint. It's going to make it
Yeah.
much easier for you to manage. And then, yeah, that remote work too. We can keep it on this slide, Sebastian, but that's something to consider too. You do need to account for all the locations. So if you're in California, you have an employee in Florida, just because they're in a different place, they still have to have workers' compensation in place. So keep that in mind. And then this again, yeah, like a slip and fall, but this being your own employee in this instance, even if it is in their own home, if it's at a general office space, if they're traveling for work and are going to be hurt, maybe at a trade show somewhere, that's where this can come into play and pick up those expenses. And this repetitive stress injuries, again, it sounds funny, but tendonitis or carpal tunnel syndrome, something like that, if you have a lot of engineers, in your employee count there, could be something to consider. You're going to need it anyways, and one of those instances would be designed to be picked up by the workers' compensation coverage. Shifting gears a little bit, employment practices liability. Now, this one actually not having anything to do with physical injury itself. This designed to protect your company against allegations of like harassment, wrongful termination, discrimination, things in that same vein. Even if they have merit or not, this is where this coverage is going to come into play. Pick up those legal defense fees, fines, settlements, judgments that you may incur if somebody were to claim, an allegation of, again, like discrimination, sexual harassment, wrongful termination, things like that. This, unfortunately, has become the most severe and frequent claim that we see here, among even above cyber or anything else that we service through our products. Um, Employee practices laws can be pretty in favor of the employees themselves. So this protecting your company, if you do get sued by an employee, they do have an average cost size of $125,000 as well. So that's one of those where we think back to, hey, do we want to kind of just avoid this and hope it never happens? We're all friends today. Will we all still be friends tomorrow? Or is this one of those things where it's like, hey, maybe it's worth the premium to then protect against a potentially hundreds of thousands of dollars lawsuit, if somebody were to claim harassment? We do typically recommend it as your team's a little bit more robust and larger. So 3 full-time employees up to 5 plus, in other states. If you're in a New York or a California, just again, based on those employment practices laws themselves, good to start thinking about it actually after that first full-time hire, depending on the cost there. And then you can see again, typically recommend a 1 million limit for the lower employee count size, and that then steadily increases as your employees grow as well there, closer to that 2, 3, 5 million range if you've got a lot.
I'm curious about trends there too, because
Mhm.
specifically to startups, I know we're coming off of a rather incredible boom cycle that kind of topped out in 2022. But something I noticed, especially in the New York scene, gosh, Midtown Manhattan was just flooded with 20 or 30-year-old somethings every lunch. And like these startups are raising funds all the time. And specifically to startups, like the work-life balance line can blur a little bit. So like people work late in the office, like people do non-standard, they don't have HR and legal in-house, to screen everything. So it's like the
Yep.
chances of, as a CEO, once you have other people in positions of leadership, which I think is right around where you're pointing at these team growth sides, and you
Yeah.
can't it is your job to control the culture of the company, to fire bad apples and do various things like that, but eventually you get into a Dunbar number where you can't recognize everybody, you weren't
Yeah.
involved in every single hiring decision, etc. And there's an eventuality, right?
Exactly. Exactly. Yeah. And I mean, tech startups move quickly and they're kind of scrappy and things like that. So, like to your point, Ryan, there, like you probably don't have a big HR book with 50 pages filled of legalese that you can pass out to everybody or make them read even. Yeah. And you can't pay attention to every single person once you get to those 25 plus kind of thresholds. And if somebody's feelings are hurt, whether again it has merit or not, or they feel like they were treated wrongfully by you or by another member of your company, can get pretty hairy pretty quickly. So that's where this comes into play to protect against those instances.
Yeah, and also I do think I forget your two by two, but there was avoid, mitigate. I guess mitigation, a lot of larger companies, right? The mitigation of this is mandatory trainings, big
Mhm.
PDF things, a ton of resources and whatnot. And you show me a 20-person startup in New York with venture capital or angel funding who's like, oh, yes, we sat everyone down today for a 2-hour
Yeah,
training course on like, you know, whatever the topic is. It's usually like, oh, no, no, we're working to survive.
exactly. Yeah, no, typically out of compliance, a lot of those guys, they've never seen an HR book. There's definitely maybe not even an HR department built out. So you're right. This would be kind of a way to almost avoid hiring an HR department. I guess in that sense, not good, not advice. That's not advice.
No, no, it's
And these would be those claims. Again, we see these frequently, unfortunately. Wrongful termination. So you receive a demand letter from a former employee alleging gender-based wrongful termination and retaliation. This is where that policy is designed to respond, pay for those fees, pay for the settlement if you do end up settling, to prevent the lawsuit from being filed. So that's something there, but can also go ahead and settle these from the claim from the policy itself if it actually does end up going to trial or something like that. And then discrimination based on disability, that can be pretty broad there too, and something that we see pretty frequently. This is designed to, again, pay for the cost of attorney's fees, those fines, settlements, judgments that you may incur. Of course, kind of up to those policy limits. Awesome. So now we've covered, hey, what do we do when we're first getting our kind of boots on the ground, getting started here, getting rolling? What do we do once we've hired a few people outside of the executive team here? How do we protect against trip and fall? How do we protect against discrimination and harassment, things like that? Now you've started signing customers, and those are going to be the coverages that we focus on next. A lot of these that we're going to touch on are going to be contractual obligations. Again, going back to Sebastian's earlier point about you'll run into these with enterprise contract requirements. But then also, since you do have active paying clients relying on your product and services now, being well protected against instances where, hey, maybe it didn't work as intended, somebody lost some money, or maybe there were to be some sort of breach. And now your data and the other third parties' data is out there, and you're on the hook for it. So those are going to be the common coverages that we're going to discuss in these next few slides. So starting with errors and emissions, this one also sometimes you'll see it in contracts or just general terminology referred to as professional liability. Now, most basically designed to protect your company in the event your products or services causes a financial loss. So think of that as meaning a number of things: misstatement, misrepresentation, negligence, product failure being a bigger one here. Products intended to do XYZ. You've promised that if you use our product, you'll have 10x growth. Hey, maybe it doesn't work out quite as planned there. Somebody ends up losing out on a little bit of money there. Somebody paid for this product that you're providing, and it's just not working like they want it to. Now you're wrapped into a lawsuit. That's where something like an errors and omissions or professional liability policy can come into play. And again, pick up those legal defense fees, the fines, the settlements, the judgments, the regulatory violations you may run into if that loss were to occur. So we do see rates in the tech sector specifically increasing along with cyber. We do see this kind of in the AI dawn kind of era here where everybody's implementing different AI services here. This is one to have in case that AI were to make some sort of mistake, and you're selling it to people, or maybe you're selling a foolproof solution to do again like XYZ, and it's just not working out as intended. This one also going to be very relevant for companies operating in highly regulated industries. So think like healthcare, health tech, the finance world or fintech world here is where this is going to be not only a requirement, but also highly recommended to get, again, just so you're not on the hook for those legal defense fees if your product were to cause one of your clients a financial loss. And then again, we're going to base this off of revenue typically for the type of an industry for the type of coverage limits we typically recommend you secure.
Do you guys help with, I guess you can actually tell us a little bit about how
Yeah.
you have a relationship with your clients? Because I know something I've seen with a lot of startups, especially B2B, when they're selling it to very large established organizations, they will get like a contract back or an LOI or something like that, and it will contain like E&O coverage levels that are
Hmm.
basically just boilerplate from the big company. It's like, oh, this is just what we send everybody. And the startup sitting there cash strapped and being like, do we actually need to bump our coverage up here? Do you help
Right.
them navigate that so that, because sometimes I think you could probably buy way too big of a coverage just to land one contract where the risk is actually minimal. It's just they didn't put the level of thought into it as the
Yeah.
startup founder would.
Yeah, no, for sure. And it's something we're definitely able to help with and help with a good amount of frequency there, honestly. So the new boilerplate requirement for errors and emissions seems to be $5 million. Everybody wants to see $5 million out there. For a lot of companies, if you're pre-revenue, you don't expect much revenue in the next 12 months, you have a few $1,000s of cash on hand, that's going to be unattainable for you. And a lot of other insurance carriers won't even quote that. So that is where we're able to come in, provide some guidance from a negotiation standpoint, provide our benchmarking guideline tools and kind of one pagers there so that you can then go back to your contract holder and kind of start that negotiation process and say, hey, we can't get a 5 million limit, or hey, we need to kind of build this into the cost of the contract here just because what you're asking for is too expensive for us at this current stage. So can certainly do that. And then did quickly see a little kind of comment come through. Is our contractors covered under this? That's a great point. Thanks for kind of backing me up there. Errors and emissions typically designed to provide coverage for full-time employees and independent contractors when working on behalf of your company there. So if they were to cause an error, maybe it leads to a software bug, something like that, still designed to be covered under this errors and emissions coverage here. And then these do typically come with a worldwide policy as well. So if you have engineering contractors in India, you're a California-based company, this is one where it's, hey, still designed to provide that worldwide coverage with an error stemming from either of those teams.
Chris, one other question related
Yeah.
to E&O. Are surety bonds part or related to E&O?
So surety bonds are going to be a kind of their own separate thing there. Sometimes we can get into the realm of crime coverage coming into play to kind of satisfy that requirement instead. But a surety bond is actually going to be a separate coverage completely from the errors and emissions coverage here.
Thanks.
Yeah. So now we're into the cyber coverage. Typical recommendation here to bundle the two. Errors and emissions designed to protect you in the event your product services causes a financial loss. Cyber insurance being important if there's a data incident or breach. So this really protecting your company on two fronts. So there's going to be first party and third party cyber. So as we know at this point, first party, think of that as for your company. So first party cyber paying for things like software remediation, the cost of notifying clients, credit monitoring, PR related expenses, forensic investigations costs if you had to enact those in light of a data breach or incident. And then third party cyber being the flip of that, really kind of the meat of the liability itself. So now you've had the data incident, you've paid to remediate it, you've paid to notify your clients. that third party is now, hey, I'm wrapped into a lawsuit. That paying for the legal defense fees, the fines, settlements, judgments, and regulatory violations you may incur there. This is also going to be one that you typically see come up in those contract requirements. They're probably more likely than not these large companies going to ask for a 5 million limit. We recommend basing this off of revenue, but then also the category and the amount of PII or PHI you have. So if you're not collecting any data, you're using Stripe for your credit card payment processing, um, typically a lower $1 million aggregate limit, meaning that's the limit for the full year of this policy, is sufficient. Now, again, if you're in fintech, you have a lot of sensitive data on hand. You're in health tech, you have a lot of PHI, or you're even handling that, storing that. That's where typically we recommend a higher coverage limit, closer to that 2 to 5 range. Again, depending on kind of the record count and the sensitivity of that data. Um, Now, this is another one where we do see a good chunk of companies reporting incidents. So about 24% of small businesses have reported a cyber breach. Not all of those cyber breaches are millions of dollars worth of damage. Some of them smaller, but then again, this is where that's policies designed to come into play to protect against the low frequency, high severity claim of a very expensive data incident or breach. So these are going to be some kind of claim scenarios that come up, one being for the cyber side of things, one being for the errors and omissions. And you can kind of see between these how there might be some overlap, right? So first one, hackers. Let's say that you experience a data breach when a hacker gains unauthorized access to your data base. They compromise a lot of sensitive personal information, names, addresses, payment, maybe their social security numbers, things like that are leaked. That's where your cyber policy comes into play. On the first instance, it helps you kind of notify those affected parties, work on the remediation, hire experts to help investigate the breach, kind of amend that and remediate it again. And then if there were to be any sort of lawsuit that stems from that, can additionally kind of pay for, again, like those legal defense fees, or if there were to be any sort of regulatory violation fines there for the leak of that sensitive data, can come into play and pick up those expenses as well. Now, the second bucket here being that like bad streaming example, this is where the errors and emissions policy could come into play. So like maybe, hey, you're offering live concert streaming services for a fee. There's a bug in that software that morning. Nobody's able to watch the concert. Um, Billboard Music hired you to kind of stream this for them. Now they're very upset because they sold tickets to this. It didn't work out. They lost out on hundreds of thousands of dollars. You're on the hook for that now. And that's where your errors and omissions policy can come into play to pick up, again, those defense fees, the settlements you may run into, any sort of regulatory violations, things like that. Um, and between these two, we can see if like that bad streaming were to happen because of a hacker rather than like some sort of accidental software bug. That's where you could see like a cyber policy and an errors and omissions policy both respond in the same claim instance. So typically why we'd recommend bundling those two just to be safe. Awesome. And coming to the end here, these are going to be some other common coverages that you might run into. So kind of just wanted to make you aware of these in general. Um, I'll kind of give you brief high-level overview and then like current kind of coverage recommendations and trigger points to consider when thinking of these. So directors and officers, that's going to be one you're probably going to run into if you're raising any sort of capital or if you've just closed a funding round. Think of it as like a guardrail for your personal finances while you're making decisions on behalf of the company. If there's an allegation of mismanagement, misstatement, misrepresentation, breach of fiduciary duties, things along those lines. Firm requirement at your Series A funding round. After you've closed that, good to start considering it closer to pre-seed and seed round as well, just to make your company a more attractive investment vehicle for any angel or VC partners you might be approaching. Crime coverage, this is something you'll see come up every now and then in a contract requirement when people are asking for coverage against employee theft. Think of crime coverage when you see those terms. Again, this is really to protect against bad actors. If there's an instance where an employee were to steal information, money, commit fraud or forgery instances designed to be picked up by the crime. Hired non-owned auto, if you're renting a lot of vehicles, if you have an outside sales team, if you travel in your own personal vehicle a lot for work purposes, something to consider as your personal auto insurance typically won't respond to any sort of commercial or business related instances if you're in an accident. And then fiduciary employee benefits. These two, again, more employee related. If you yourself are administrating those benefits, responsible for making the management decisions of a 401k, that's where you would want to kind of get this in place. Or again, if you're actually administrating those health, life, disability benefits yourself, that's where you'd want to get the employee benefits liability. Those two really typically, again, covered by your PEO or payroll provider there. So you can typically exclude those from your insurance package. And then media liability. If you're producing a lot of content, whether that be on X, whether that be kind of just blog posts, emails, sending out physical mail to people, if you're worried about an instance of copyright infringement or IP infringement, that's where a media liability policy can come into play. Maybe you have a company, you've put up their logo on your website, they ask you to take it down. That's going to pay for those expenses related to that.
Cool, Chris. And I know this is kind of the end of the coverage
Yeah.
details section, so figured now might be a good time for Q&A to
Yeah.
address some of the open questions. So I'll just kind of read them off here, starting with the first one we received, which was about, is a $25 million umbrella policy unreasonable for a 100 kilowatt pilot battery project tied to a small building? I'm sure there's probably a little bit more details that might be needed to like
Right.
fully say exactly what coverage is needed, but you want to give maybe your thoughts about how you'd approach this.
Yeah, for sure. And you're right. I'll start with my favorite saying is it depends. Um, I would look at your current revenue. Again, that's like how we largely base off a lot of these coverage limits. If the contract holder is requiring a $25 million limit, 25 million umbrella is going to be very, very expensive to obtain. So again, what are the budget constraints kind of around that? And are carriers even willing to quote you at an earlier stage depending on that? And then kind of would also consider like what's the risk of that actually happening and burning down something like a $25 million building? I would think it'd probably be pretty far off in that case. So it seems first glance to be maybe a little bit of an excessive request. But again, would need more details about the product itself, the revenue figures, if it's related to any sort of contract requirement, and then kind of any sort of like budget or constraints around the premium itself, since that'd probably be a pretty hefty, expensive policy there.
Cool. Thanks, Chris. And next question. How does the auto industry protect itself from accident losses resulting from car crashes? And I think this is getting at like, Ford or General Motors, like how do they protect themselves from accidents? And maybe I assume this one goes to errors and emissions or product liability, but you want to take this one?
Yeah, that's a tough one. So what, like a Ford, if they make a car and they sell it to a dealer or to you, they no longer are kind of responsible for that unless they've kind of gone ahead and like there's some sort of product deficiency that they put into the vehicle that's causing it to not brake or your radio to act funky or something. I'm not sure what an insurance program for like a Ford or somebody looks like. I'm sure it's millions of dollars and does probably include like product liability and errors and emissions there as well if they were to make some sort of mistake.
But I think the actual crashes are obviously like like if it's
If you're
human driven,
driving a
I'm sure it's a
car,
personal.
yeah, yeah. If you're driving a car and you run into a pole or you run into another car, the auto industry has nothing, absolutely nothing to do with that. Again, unless it's something where like it's Ford's fault that you weren't able to hit the brakes. Yeah, that's going to be kind of on your personal auto. If you're driving for work, that's where you'd want to look to something like the hired and non-owned auto if you're doing a sales call or visit or something like that.
Cool. Thanks, Chris. Last question I see. What about incidental medical liability coverage for a health tech company? And I think I can kind of
Yeah.
think they'd approach this from like the health tech is causing a actual physical ailments issue. I think that's the way that I'm digesting this question.
Yeah, no, that's a great question. And that's something where almost two-sided from a coverage perspective and then response as well. So with an errors and omissions, some carriers, Vouch included, are able to go ahead and modify the policy language and add endorsements, which modifies the policy language to go ahead and pick up expenses, personal injury damages, or physical injury that may have occurred from the health kind of practices that you're administrating digitally. So that's what they're able to kind of do. Again, amends the definitions within an errors and omissions policy to say, hey, if you're injured because of the medical advice or treatments or anything that was administered digitally, this is designed to come into play. Now, again, that would be if it's specifically just all digital. If there's a doctor or some sort of like primary care physician or somebody like that involved, and it's like a brick and mortar clinic or something like that that you'd go to, we'd actually want to get something called a medical malpractice coverage in place for that provider. That then is intended to do the same thing for the healthcare that you're administrating in person and physically. Again, if there's an instance of like personal injury or physical injury that occurs from those health kind of things administered in person. So that's what I'd look like. Yeah. So kind of two-sided there. It doesn't hurt to have both in place. You're typically, if you're working with larger hospitals or things like that as well, would want to see a combination of like the digital health coverage and the medical malpractice coverage in place.
Cool. And then there was one more question about, I think with respect to a healthcare clinic, but how would key man or key person risk, I think is what it's called now,
Yeah.
key person risk like insurance, like how would that apply, I guess, like to say like a physician running a healthcare like clinic where they're the only provider, like that type of scenario.
Yeah, yeah. And key person, think of that as like life insurance basically. So really designed to protect like the very important people at your company. So like the CEO or like that sole provider at a clinic. Maybe you're relying on them to generate a lot of revenue, things like that. The key person insurance would come into play if they were to unfortunately die and then pay out similar to a life insurance policy, where it's then kind of reimbursing your company for potential like lost revenue, but then also the expenses associated with trying to find a similarly competent person to take over that leadership role or clinician role there.
Right.
So
Thank
that one, yeah, yeah, less to do with the operations themselves and more to do with replacing an actual like human being if they were no longer able to do their job.
Cool. And I think we had one more question from Dr. Felicia on and it's a great structural question about insurance. Like, is there anything that, if there's a major event that occurs like COVID that reduces revenue over a period of time, is there a type of insurance that covers that type of scenario?
It's a great question. It's going to depend on the carrier and their policy language as well. Most people will offer business interruption coverage through general liability or something like a cyber in the event of a data breach specifically. Pre-COVID, the policy language was pretty vague from a lot of carriers from a general liability business interruption standpoint there, which caused a lot of confusion about who's on the hook to kind of pay for those business interruption expenses. Now that we're living in a post-COVID world, some carriers have taken a more proactive approach to actually clearly define what would happen in the event of a COVID type scenario there. Some willing to include that coverage. Again, kind of depends. I would check with your broker on that side. Some excluding that coverage specifically in the event there's to be some sort of major worldwide shutdown due to COVID related or disease related kind of instances again there.
Thanks a lot for all the insights, Chris.
Yeah, thank you guys.
Cool. I've seen a couple questions come up in the chat just about speaking with Vouch, speaking with Chris or another member of the insurance advisor team. And Vouch does a great job of blending a digital-led experience to allow founders to go through, apply, get a quote, customize the quote, and then bind coverage, all without any human touch involved if that's the desired path. If you'd like advice during that process, we have matched human advice with that digital-led experience, where Chris or another member of our insurance advisor team we'll be able to, set up a call with you to speak about some of the specifics related to your business and what, coverage levels, types of coverages, et cetera, are most appropriate for you. So go ahead and visit the vouch.us/Gust link, and you'll automatically get a 5% discount on all of your Vouch coverages. That applies in perpetuity. That's not just on the first year of coverage. So if your business grows significantly from year 1 to 2, and that 5% discount will persist. So we also have a number of other resources for you to visit. I mentioned that insurance milestones guide. That's also on the Vouch website. That kind of breaks out different stages of growth and what types of coverages are relevant, much like we did in this presentation, but takes a different spin with obviously more of like a blog approach. We have a couple other documents on our blog post portion of our website about cyber and errors and emissions. I have them linked here, and we'll follow up with these. And then we also have a risk assessment tool just to help you kind of assess what types of coverages are most relevant. It asks for types of employees, revenue, all of those types of inputs that Chris has went into about pricing and limits today, and helps you just get a cursory overview. Of course, we suggest that you apply and then to have a conversation if you're interested in diving into more of the details there. But we'll follow up with some of these resources as well as this deck, and really appreciate getting to spend the time with all of y'all and giving us an hour of your day. We're, hopefully you enjoyed the presentation, got a lot of value of it, and, would be happy to take any questions. You can reach out to me directly, sebastian.schmidt@vouch.us. I can help connect the dots with one of the insurance advisors on our team for any, specific questions that I might not be able to address. Ryan, thank you for hosting us. Any last comments or questions from you?
No, I'll be sure if you want to send me over, we'll trade lists so that everybody gets access to recording links because we're doing the recording. You guys have some of the resources, but anybody who, if you are SVP'd or you showed up here, we'll be sure you get all these materials. And look out for, we'll bring Vouch back, probably in, at least a quarter or so to just keep on about the path and making sure that you're protecting the value you create in your startup. As always, Sebastian and Chris, it's fantastic to have you. You guys are full of information. You actually make insurance approachable and tangible rather than just, I mean, I started as a CTO of Gust, and we would literally just get these PDFs sometimes printed out, and some from admin would come in and be like, "We have to renew all these insurance things," and I would be like, "I could read all these, break it down and understand it, and maybe save some money, maybe find out I have to spend more money, da 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 da." And there's a lot of inertia in companies, especially as you're growing. So it's really great to have a solution out there that can be a little bit more fit to where you're at.
Greatly appreciate it, Nash. And thanks a lot to all again. Great meeting y'all.
Yeah, awesome, guys. Have a
Thanks for
great
your
rest of your
day.
week, everyone. We'll see you soon.